Hello and welcome, friends, to our weekly webinars. This is 21st of April 2018, and this is Proficient Equities Private Limited. Myself, Shumoy Goswami. As you know, we have been conducting this webinar for past 2 months, and sometimes we talk about educative topics, and sometimes we talk about the current market scenario. Last week, we were talking about moving average and the contemporary approaches to moving average. This week, we will continue with the topic, and I hope you will get some more food for thought and more ideas for your own trading, as far as including the moving average part is concerned in your trading arsenal. Okay, today I'll be showing you some innovative ideas of using moving average, right? Last week we were talking about moving average, convergence, divergence histogram, that is MACD histogram, and I had given you a particular combination of MACD histogram and 200-day moving average, which was acting as a robust trend indicator. That is, when prices were during an uptrend, we were having a long position, and when prices were pulling back during that uptrend, we were not exiting our position and we were holding our long position so that we can successfully overcome the pullbacks and ride the primary trend. So that is the very objective of any robust trading system, that there should not be any change of signal just upon any pullback or just upon any retracement. So that's the primary objective of any robust trading signal. Now, this week, I think some more interesting trading ideas I can give you in this particular issue, right? Now, so let's start. What, in your opinion, is the strongest signal in moving average, right? We have seen that there are various kinds of signals like moving average crossover. Say, for example, in my chart, as you can see here, there are two moving averages. One is the red one, thick line. It is the 200-day moving average, and other is the 50-day moving average. Both are simple, right? So when prices are going above these moving averages or below these moving averages, say for example, in this zone, prices were below this particular moving average, right? And so this can be taken as a valid. This can be taken as a valid sell signal. When prices are going below the moving average, it is a sell signal, right? And when prices are going above this moving average here, after a brief violation downward, this is a buy signal. We all know this. There is nothing new about it. This is the first kind of trading signal that we can get from moving average. Other important thing is when a short-term moving average, just a minute, yeah, the other important thing is when a short-term moving average is crossing over a longer-term moving average. That is another kind of trading signal. Say for example, here, the short-term moving average of 50-day is actually going above the long-term moving average of 200 days. So this is a valid buy signal. These things are pretty well known. These things are pretty common as far as technical analysis is concerned. The important thing to note here is that these kind of signals give many whipsaws, many losing trends when prices are actually in a choppy phase, right? Mm, and there is not much that you can do about it, right? There is not much that you can do about it, because these kind of trading signals actually give you more number of losing trades with average losses less, and lesser number of profitable trades with big average profitable with big average profit. So net you will be in a profitable trades, although this has to be tested, and you will have to take many losing trades, right, during a choppy phase. So today I am going to ask you, what is the greatest signal as far as moving averages are concerned? Now I'm telling you, the greatest signal of moving average is actually the slope of the moving average, right? Slope of the moving average. Now what do I mean by slope? Slope is something that if today's value of the moving average is greater than the value yesterday, then the slope of the moving average is said to be higher, right? I'm showing you here. Suppose, look at this region here. Consider the blue line, which is the 50-day moving average, and consider this particular zone, right? Yeah, consider this particular zone and look at the moving average. Look at the moving average. Moving average, the value of the moving average to the left of this ellipse was actually declining. It was falling. It was falling, and prices were in a downtrend. It is at this point that the moving average actually changed its slope upward, right? So from this point, we can say that the trend has turned upward, and this uptrend is continuing for an extended period of time. So prices actually crossed over this 50-day moving average a few days earlier, and that does not mean the slope will be changed immediately. The slope, moving average slope, is a very robust indicator, and it does not change every day. It changes only upon a lot of things are happening, and it is a late signal, but it is a very reliable signal, as I can tell you. As you can see that at this point, when the slope of the moving average is changing here, we are getting the signal of an uptrend, and this signal of an uptrend can be taken as a buy signal, right? Now I'm going to the right of the chart, and you can see that the slope has remained upward. Sometimes the upward slope has been decreased here. The acceleration has been decreased, but the direction of the slope has remained upward for a very long period of time. And although there were intermittent price violation downward, and these are the things that these violation will give you losing trades if you go by the crossover signal. That is, if you assume if price closes below the moving average, it is the end of an uptrend, then at this point you will be getting losing trades. But as far as the moving average slope is concerned, the moving average slope does not turn immediately whenever there is a price violation, right? Now it is at this point that there was a brief decline, change of slope downward, but again the change of again the slope increased from here, and the slope remained upward, right? Yeah, there was no violation here. There was no, there was a price violation, but the change of slope did not occur here. So you can see in this period that many times prices actually 1, 2, 3, 4 times prices actually closed below the 50-day moving average. So if you go by the crossover or violation signal of the moving average, then you will be getting wrong signals 4 times in this 12-month period. But if you go by the slope of the moving average, then you will be wrong in only one instance, right? And that's the beauty of the slope. So slope of the moving average is a very important trend indicator, right? And to the right of my chart, you can see that the slope has turned downward. Slope of this moving average has been turned downward from here, right? At this point, the slope of the moving average has turned downward. How do I say this? Because initially you can see the value of the moving average was rising, and at this point the value of the moving average is actually below the previous day's value. So at this point, this slope is downward. The slope has changed, right? And this is another exit point from your uptrend, from your long position or whatever. Now come to the right of the chart, and the slope is still downward, although the acceleration has been decreased. Yesterday the value was 10,366 and on Friday 10,364. So value has been the acceleration has been stopped. Acceleration has been halted, and there is a high probability that the slope will change here, and that will give you a very strong signal of change of trend. So in my opinion, the change of slope of moving average is actually the strongest signal that we can get from moving average, right? Now there is another point of consideration here. It is that why or what is the time period of the moving average that we should take, right? Suppose we are using here 50-day moving average. Why 50-day moving average? Why not 10-day moving average? Why not 200-day moving average? All these questions will come. Now, here is a certain point of consideration that I am telling you is that 50-day moving average or 100-day moving average will give you only one particular window, right? Only one particular time frame to consider, right? The slope of the moving average will give you only one particular. A 50-day moving average has a look back period of only 50 days. A 100-day moving average has a look back period of only 100 days. But from my experience, I have seen that instead of one particular time period, if I look at a region, right? If I look at a region, what do I mean by region? I mean that not only suppose I am using a 50-day moving average, but when I am using 50-day moving average, I will use all the moving averages from 50 to say 40, right? All the moving averages from 50 to 40, that is 50-day moving average, 49-day moving average, 48-day moving average, likewise 42 days, 41 days, 40 days, all these moving averages. So this will form a cluster. This will form a cluster of moving average. This is definitely, this choice of moving average is definitely a function of the time period that I am trading, right? This cluster is definitely a function of time period. That is what kind of time period that I am trading in my own account, or what is the amount of risk that I am willing to accept, right? So these things will decide the length of this moving average. But from my point of view, I have seen it more. The robustness increases once you use a rainbow of moving average, right? A rainbow. By the term rainbow, I mean there is a group of moving average, not only one particular moving average. I'm using here suppose 10 moving averages, right? So in this, while you do this, then you will get not only a particular window but a cluster of time period whereby you can use that particular cluster for all your trading decision. Today, I will show you one such indicator that I use, that I have created for myself for my own trading, and this indicator actually uses this conception that I'll be using the slope of the moving average, and the slope of the moving average is not of one moving average but of a cluster of moving average of one particular zone, suppose 50 to 40 zone, or 100 to 90 zone, and all those things, right? So let's start. This is the very conception of moving averages. The thing that I am going to tell you here is I'll be using the slope of the moving averages, and I'll be using a cluster of the moving averages for the slope calculation, right? Here, I'm going to use, suppose, the indicator builder, and I'm going to create a new indicator, right? Suppose I'm opening the indicator builder, and you can follow my steps, and you can do it in your own terminal as well. I'm creating a new indicator, and I'm giving the name Proficient Moving Average Rainbow Bullish, right? I'll be actually creating two indicators, and I'll be giving one name as Proficient Moving Average Rainbow Bullish, and I'll be creating the other oscillator as Moving Average Rainbow Bearish. Now, my trading decision will be based upon both these indicators, right? I'm showing you how do I create this particular indicator from the moving average based on its slope, right? Now, I'm starting with an if function, and if, suppose I'm starting with a 50-day moving average, 50-day moving average, that is C, 50, S, is greater than yesterday's value of the same moving average, C, 50, S, -1, right? Now this may be new for you because I have been using here the reference function, and maybe I have not explained it earlier, but this is nothing difficult. As you can see, reference function I'm using here to refer the same, refer the value of one particular indicator here, for this case moving average, the 50-day moving average of yesterday's value. -1, the term -1 actually refers to yesterday's value. If I am using here -2, that means day before yesterday. -3, another day prior to that, right? So reference indicator, comma, -1 means I am using the moving average, I am using the yesterday's value of this indicator, right? So this is my syntax. If today's value of the 50-day moving average is greater than yesterday's value, that is the actually I'm defining how the slope is rising, right? And I could do my trading only based on this indicator, but here I am telling you to base your decision on a cluster of moving averages, right? So I'm using here another moving average and moving average of suppose C comma, suppose I am taking 48-day moving average is again greater than the reference function of moving average C comma 48 comma S comma -1, right? So I'm also using the 48-day moving average slope is rising, and this way I'm using more moving averages here. I'm using here 46 period. The slope of the 46 period moving average is also rising, and the slope of the 44 period moving average is also rising, and I'm using another two moving averages like 42 and finally I'm using the 40-day moving averages. So I'm using it with a decrement of 2 days, and I'm using here 6 moving averages: 50, 48, 46, 44, 42, 40, right? So I'm using the 6 moving averages, and I will define an uptrend when the slope of all these moving averages are actually increasing, right? So that's how I'm trying to achieve robustness, right? So I will define an uptrend when the slope of all these moving averages are actually rising. That is, today's value of these moving averages is actually greater than the value of yesterday, of all these moving averages, right? And this uptrend, my logic is that this uptrend will remain intact until all these moving averages are actually sloping downwards. So that's how I am defining my uptrend and downtrend. So my uptrend begins when the slope of this moving average, all these moving averages have been started to rise, all these moving averages, right? And sometimes what will happen, sometimes 1 or 2 moving averages, its slope will be decreased, right? But not all the moving averages. I can expect that not all the moving averages will give me a whipsaw signal. So unless all the moving averages are actually giving a lower slope, my uptrend will remain intact. And once all the moving averages are actually sloping down, that is the beginning of a downtrend. That is the beginning of a new downtrend, right? And this downtrend will again remain intact unless all the moving averages again slope upward. So that is how I am trying to achieve robustness, and that is the very reason I'll be using 2 different oscillators to attain the same goal, right? So let me see if how this pans out. So here I have given a condition, which is that if all these moving averages, today's value of all these moving averages is actually rising, is actually higher than that of yesterday's value, then give me a value of 1, right? I'm creating an indicator which is defined like this. If today's value of all these moving averages is greater than yesterday's value, then give me a value of 1, else give me a value of 0, right? And this is how my condition ends. And yeah, I have made no syntax error. It's good. So Let me try to plot this indicator, right? Okay, here I go. Yeah. So as you can see from this diagram that this indicator right now we created, and this indicator has only two values. One is the higher value, which is 1, and the other is the lower value, which is 0. When all the moving averages are actually sloping upward, we are getting a value of 1, right? And these things are occurring, these whipsaws are occurring when any 1, 2, or 3 of the moving averages are actually not sloping upward. Maybe they are sloping downward for a brief period of time. So we are getting this. But just because these things are occurring, we will not say this is the beginning of a downtrend. Because to define the beginning of a downtrend, we will have to see all the slope of the moving averages are actually going down, right? For that, we will create our second oscillator, and this is where we will go. Now let us create our second oscillator, and here we are copying it, and again we will create a new indicator. First, let me do the name properly. I will name it as Proficient Moving Average Rainbow Bearish, right? And all the moving averages are same, all the syntax are same, except that I am right now using a less than signal. That is, today's value of the moving average is less than yesterday's value of the same moving average, right? So now I'm using a less than signal instead of greater than signal, and all the other parts are remaining same. Okay. Okay, I'm done. And again here I will get two values. If this condition is met, if this condition that all the moving average are actually lower than yesterday's value, today's value is lesser than yesterday's value for all the moving averages, only then it will give me the value of 1, else I will get a value of 0. Now let us check if it is accepted. Yeah, it is accepted. Done. Great. Now I am going to plot this again, and here we go. Okay. So this is the second oscillator that we have created here, right? And as you can see, the blue one is my bullish oscillator, and the red one is my bearish oscillator. And look at the chart. This is the Nifty diagram on daily chart, and you can see here from July 2017 till date, which is April 2018. And at these regions, let me show you how I target to achieve robustness. Look at these zones, right? Look at these zones. Yeah, look at these zones. What you see here is that the rainbow bullish indicator was actually giving me a signal that not all the moving averages are sloping upward. That's why it has given me a 0 value in these regions, right? But that does not mean that all the moving averages are sloping down. 1 or 2 of these 6 moving averages may be sloping down, but not all the 6 moving averages are sloping down. How do I know that? If all the 6 moving averages were sloping down, then the middle part, then the middle, the bearish indicator, the rainbow bearish oscillator, will give me a value of 1, which occurred here on this particular date, right? On 5th of March, this thing occurred. So this is the beginning of a new downtrend on 5th of March, when all the moving averages actually sloped downwards. So this is the beginning of a new downtrend. And when all the moving averages were actually sloping upward during the uptrend, but one or two moving averages actually did not conform and they sloped down, that did not change the entire trend. That is how we are trying to achieve robustness. Okay. Now in this particular period, this indicator also gave us a whipsaw, which we have to accept very generously. No indicator can give you a right signal in every market conditions. That is the point here. But look at the robustness of this indicator. Look at the robustness. Right now, you are seeing some 2 years of data on my chart. And in this data, the 2017 January, look at the period 2017 January. Here, you can see my mouse roaming over here. The great bull market started here, and we got a very good signal in this period. In this time, all the moving averages actually sloped higher, and this bull market was actually intact till February end of 2018 or March beginning of 2018. And in this long period of nearly 2 years time, we have got only one sell signal which was wrong. We got only one wrong signal, right? So this is how we achieved robustness. And prior to that, we got a good sell signal here. As you can see, the rainbow bullish indicator gave a value of 0. When the rainbow bullish indicator is giving us a value of 0, that is the time we should be very vigilant. And if in that time or 1 or 2 days later, I also get +1 value of my rainbow bearish indicator, what happened here? What happened here? That is again beginning of a downtrend and beginning of a sell signal, right? So now let us come to the current market condition, and you can see here that the downtrend at this point on 5th of March, on 5th of March 2018, the rainbow bearish indicator gave us a sell signal, and few days, 2 or 3 days prior to that, the rainbow bullish actually went to a dormant phase. So this was the beginning of a new downtrend, right? And come to the right, at this point, both towards the right of the chart, that is as on 20th April 2018, that is yesterday, both the bullish and the bearish rainbow indicators are actually in a dormant phase. This cannot continue for long. Very soon, either of the two will attain its one value. But as far as today's data is concerned, since the previous signal was of a downtrend, we have to assume the downtrend is continuing unless and until the rainbow bullish indicator, which is in a dormant phase since 28th of February, actually this indicator, unless this indicator goes to a +1 value, we are expecting this will happen sooner than later if the market keeps rising like this. So that will be a time when we will be getting our bullish signal. That means all the moving averages will be sloping higher, and that will be time this indicator will give us a buy signal, right? Yeah, as I told you, this is a bit late, but this is more reliable, right? Now, before I end, there is one more thing that I will like to convey you is that whatever be your trading technique, you can adopt this ideas from moving average cluster using the slope of the moving average or any other thing that I am going to give you later. It is wise not to use the same technique for your entry and exit purpose, right? Because in entry you have the choice of making your decision. I will not enter unless certain things are occurring in the market, right? You have the choice before you are entering. But once you are inside the market, you have no choice, right? You have to move along with the market. If the market goes higher, you are going higher. If the market goes lower, it is taking you along with you. So, and your entry signal was more robust, right? But your exit signal has to be more sensitive. You cannot make your exit signal as robust. You have to make a sensitive exit signal by protecting your profits and by minimizing your losses as much as possible. So this is a good entry signal, but for as far as exit signals are concerned, you have to use some bit more innovative ideas. So for example, say for example, we are using this idea on daily chart, right, of the moving average crossover. Now, if you go by this particular signal, you can use the same logic, but not on daily chart, use it on hourly chart, right? On hourly chart, it will become more sensible, it will become more sensitive, right? Maybe on hourly chart, you have already got this signal, the moving average bull signal. All the moving averages have actually turned higher on hourly chart. So you have got your exit short, exit from your short position on the hourly chart. So this is an important conception that you have to keep in your mind. You cannot base both your entry and exit logic on the same particular idea. And if you do so, you have to go one time frame lower for your exits, because you have to keep it more sensitive, right? So that's the basic logic of today's session. My idea was to give you a robust trading signal, which is a bit more contemporary in nature, not the conventional use of moving averages that have been used over years. And I think you have liked it. This video will be posted in YouTube as well. Keep liking our videos and give us queries if at all any. And goodbye for now, and meet you next week. Thank you.